Welcome to FT Markets. The closer we get to December, the more the market believes that we are on the cusp of the great unknown, divergence between the big two central banks, as the European Central Bank prepares the market for the prospect of easing monetary policy at its meeting next week. The Federal Reserve is priming the market for a rise in US rates 2 weeks later. So, what will this divergence look like? And what are the consequences for countries that might be stuck in the middle, such as Switzerland? Well, with me to discuss this is Marvin Barth, Head of European FX Strategy at Barclays. Marvin, welcome to FT Markets. Can you just help us with this issue of the dovish hike, which has become part of the commentary of a lot of FX strategists, and how, while the US will raise rates, it's not going to go for a very, very strong tightening cycle?
Yeah, so this really comes back to the Fed's concerns about inflation, right? So they look at the output gap, they look at measures like unemployment getting down towards 5%, and they see, gosh, we should start getting inflation pressures, and yet we haven't seen them yet. So you want to start raising rates just in case there's some nonlinearity ahead that's going to cause a very sharp appreciation in inflation, but you can't do it that rapidly.
Okay, let's look at the first chart you very kindly brought along, which illustrates this. Talk us through this, Marvin.
So this is one of the things that is going to help suppress inflation next year in our view. So if you look at the broad nominal dollar, the blue line inverted on the right, the appreciation that we've seen in the last year is having an impact on import prices, right. And that's going to pass through to broader inflation. We think that that's going to dampen inflation early next year, and this is what's going to lead to a pause in the Fed hiking cycle.
You think around what, about June?
We're looking
time?
for June for them to take a pause. So they'll hike in December, they'll hike in March, they'll have gotten themselves firmly off the zero lower bound, but then they look at this still soft inflation and they say, why don't we take a pause and assess the effect of these first two hikes on the economy?
So that's one impact of inflation. And the second chart is going to look at the impact for the eurozone area. So if the US has an issue with inflation, yes, it's nothing compared to Europe.
Yeah, the big difference between the euro area and the US is, of course, the US has its output gap almost closed. You know, we're almost at full employment here. In the euro area, we still have very high unemployment. And as a result, whatever's been dragging inflation globally has an even bigger effect there. And so even throughout our forecast period, we don't see either core or headline inflation getting anywhere near the mandated levels.
2% is the level, isn't
it?
So, and you're looking this, what, all the way to 2018?
This is all the way through the end of 2017, which is how far out the ECB forecast. Our forecasts are actually below the ECB's forecasts out there. We're only at 1.3% out at the end of 2017. So this is well below target. You're not even anywhere near it. And this is having a dampening impact on inflation expectations, which is exactly why President Draghi last Friday made it very clear that they must act. They must do something more to try and pick up inflation.
So there we have the whole point of divergence is to get inflation going, but your basic call is it's going to take time, isn't it?
It takes a lot of time, and you know, the real interesting dynamic here is if you go back a few months ago, everybody was expecting dollar strength to come from divergence with the US rates pulling the dollar up, but now we actually have divergence in both directions. You have the US pulling up rates and the ECB pulling down rates, which is going to cause an even greater Atlantic divide here.
Right, I mentioned Switzerland at the start. If we thought the US had difficulties and the eurozone, the third chart tells us that it's really nothing compared to Switzerland. You have a very, very strong call on this, don't you?
Yeah, so you know, put yourself in the seat of the SNB here. The ECB is about to start using more negative rates, the tool that you've been using, that's finally started to have an impact on your exchange rate recently. And all of a sudden, they're going to start cutting that interest rate differential on you. Now, you either can let your exchange rate start to bear the brunt of that, or you can go tit for tat with the ECB potentially further down when you're starting 55 basis points below them. That's not a comforting place to be. You can't let the currency go. Your pension funds are screaming about the negative rates.
So Swiss Central Bank meeting is on December the 10th.
A week after the ECB.
And you think?
So ultimately, this other line here is very few of the reserves of banks in Switzerland are actually taxed with this negative deposit rate. It's only about a third of them. Our call is that their obvious choice here is actually to remove those exemptions, which means all deposits at the S&B would start to be subject to this negative 75 basis points. That would effectively force the Swiss banks to pass on negative rates to retail deposits. That is what will give you serious divergence.
And that's going to create a shock. We've been talking all year about the idea of monetary policy divergence. We're on the cusp of it, as I said. And to conclude, you think it's okay getting there, but it's going to look pretty messy once we're there. Is that your basic position?
Well, I wouldn't say that it's going to look so messy outside of Switzerland. I think this will be a real shock to people.
Yeah.
In fact, if you look at the way option markets are priced, they're priced exactly wrongly for this. They're still trying to shut the barn door on what happened in January this year, trying to protect against an appreciation of the Swiss franc. But in fact, if they do something like this is why we call it their nuclear option, is that this will have a big, meaningful effect on depreciating the Swiss. But in terms of the broader euro-dollar relationship, we've already seen this expectation of this policy divergence play out in an orderly decline in euro-dollar, which is what we expect to continue.
Okay, Marvin, thank you. So the FX year began with a big shock coming out of Switzerland. And if these guys are correct, it's going to end with another big shock.